Welcome on board Ashwini Hooda, the DMD at Indiabulls Housing Finance, joins us in the show right now. Ashwini, hi, morning. While you've been able to report a very strong profit growth of 22% and similar projection on the NII, what's led to this kind of strong growth? What were the factors driving this?
So the main drivers have for the recent past have been the growth in the affordable housing. That segment has been growing at 30% plus, and we being concentrated only on that segment where our average ticket size is 24 lakh rupees. We are large beneficiary of that growth, and that is helping company to post, for example, this financial year the loan book has grown to loan assets have grown to 1,22,000 crore, which is a growth of 34%.
Right. We've seen compression in spreads at 311 bips versus 324 bips year on year. And if you look at your presentation, the yield is down about almost close to 77 basis points versus, the cost of funds that have eased 64 basis points. I know I'm getting a bit technical here, but what will you attribute this yield compression to, and this return compression to? Is it due to competition? I mean, do you think that pricing on loans is coming off?
So our spreads have marginally contracted this quarter because the money market yields went up substantially, almost 1% between November 2017 and March 18. We have not passed on that cost last quarter, but beginning this quarter we passed on that 20 basis point increase to our home loan customers. So we are a pass through, and interest rate per se do not impact us apart from a short term compression. So spreads will be back to where they were earlier after this financial year. I must add that we were upgraded to AAA by international rating agency S&P and Moody's Indian companies CRISIL and ICRA in financial year 18, and that puts us in a very unique footing where even while interest rate costs go up because yields have moved up, our effective yields are still coming down as our spreads over government bonds keep contracting. So we are in a unique position where for next 24 months, as our old bonds come for repricing and our newer borrowings happens at AAA rates, we would be saving our cost of fund will even come down because our average cost of fund is still higher than our incremental cost of fund.
So with the interest rate cycle now changing, by how much have you seen a rise in your cost of deposits so far in the first quarter, and also in your yields, and in what range do you hope to maintain your spreads going forward?
So on an incremental basis, cost of funds have moved up by around 30 odd basis point. The main increase has happened in the bond market, where costs have increased by 60 to 70 basis point. So we from a pass through perspective, we believe that current rate cycle should not be resulting in more than 50 to 60 basis point increase in average cost of fund for the company, and interest rates have come down a lot in last 2-3 years. So a 50 basis point increase overall should not hamper any growth on the home loans also.
Okay. If I look at the HFC industry, I'm just getting a sense that the NPA issue seems to be coming up now, and some of your peer companies have admitted that NPAs could be a concern going forward. What is your experience? Are you feeling the heat of NPAs, or as of now there is no problem?
So as you would have noticed, our gross NPAs have been coming down. So clearly we are not seeing any NPA problem in home loan business, which is seen structurally. NPAs come down. We have a very seasoned team. We've been in this business underwriting mortgages for now 12-13 years. So that vintage plus good focus on credit quality continues to help company to maintain NPA below 1%. We currently are at around 77 basis point. we have guided our shareholders and all other stakeholders that we will keeping our gross NPA between 70 to 90 basis point, and we are not seeing any headwinds as we speak to see that limit breaching in short term.